Something is breaking beneath the surface of the financial system. No emergency press conference, no front page headlines, no official warnings, just money. In the last few days, the New York Federal Reserve has quietly injected tens of billions of dollars into Wall Street banks. At the same time, stress is rising in the gold and silver markets. This is not normal, and history tells us we should be paying attention. Let's start with the facts. For more than 5 years, from mid-2020 until recently, the New York Fed barely provided any emergency cash to Wall Street banks. Then suddenly, starting around Halloween, that changed. On Halloween, one or more major banks received $51 billion in emergency cash. On the day after Christmas, another $17 billion was injected. On Sunday evening, December 28th at 5 p.m., when banks are closed, the New York Fed injected another $34 billion. This was not the end. Then $29.5 billion on January 2nd and $19.5 billion on the 3rd. No explanation, no name banks, almost no media coverage, just a flood of liquidity. Emergency lending itself is not unusual. Banks occasionally need short-term cash. The Fed provides it through a mechanism called the repo market, where banks post collateral and receive liquidity at very low interest rates, protected from bankruptcy proceedings. That's not the concern. The concern is timing and scale. After more than 5 years of calm, we suddenly see multiple massive injections in rapid succession, coinciding with rising volatility in precious metals. This is not random. This is stress. Here's where it gets darker. On December 10th, the New York Fed quietly removed caps on how much emergency cash it can provide to the banking system. That announcement went largely unreported. Under the new rules, depending on how you read the language, individual banks may now access between $80 billion and $240 billion per day. Ask yourself a simple question. Why remove lending limits now unless you expect to need them? Enter silver and gold. Almost immediately after this latest cash infusion, something else happened. The Chicago Mercantile Exchange, the CME, quietly tightened margin requirements for trading silver and gold. Officially, this was described as a routine response to volatility. But the timing matters. Margin hikes force traders to post more cash. They reduce leverage, and they are often used when exchanges fear disorderly moves or forced liquidations. This announcement was sent to subscribers. It was not meaningfully reported in the financial press. At the same time, silver prices have gained 160% over the past year. According to public disclosures, one major Wall Street bank, JP Morgan, reported that one of its units sold roughly 5,900 tons of silver it does not own. That is an enormous short position. And when prices rise sharply, short sellers face margin calls, demands for cash that must be met the same day. If they can't meet those calls, they must liquidate or find liquidity. During Christmas week, silver prices spiked above $84 per ounce on one exchange before falling sharply. On another exchange, prices surged less, but still dropped over 11% in a single day. This kind of volatility is exactly what breaks leveraged positions and exactly what forces banks to scramble for cash. We have seen this movie before. In 2008, liquidity evaporated. Emergency facilities expanded. Limits were lifted. Cash flooded Wall Street, and then the system broke. The great financial crisis wiped out years of economic progress. Entire generations never recovered. Low-income families at the time were financially devastated. By some estimates, the U.S. economy lost the equivalent of 2 full years of output, tens of trillions of dollars, due to systemic failures and unchecked risk-taking. The warning signs were there then too. They were ignored. What's most disturbing is not just what's happening, it's what's not happening. No major Wall Street publication is covering this in depth. No serious discussion of why limits were lifted, no transparency on which banks are receiving these funds, and no answers yet from JP Morgan, despite multiple requests for comment. To be clear, this does not mean collapse is imminent. It does not mean the system is about to fail tomorrow, but it does mean stress is rising. It does mean something is wrong. And it does mean precious metals markets are flashing early warning signals. Liquidity injections, policy changes, margin hikes, violent price swings. These are not the signs of a stable system. They are the signs of one under pressure. Stay alert, stay informed, and don't assume silence means safety.